ಇನ್ನು more than one deputy director ಸಿಗಬಹುದು. Welcome to the session on the concept of working capital management as applicable to the MNCs, the multinational corporations. Now you see of late the business houses have started operating in global market and more than one countries. So when you're operating in more than one countries, there could be typical problems earlier in 1960s and 70s and 80s, when the economic liberalization had not crept into India. The companies were basically doing their operations in a single, the companies were doing their operations in a single country like India. So all the rules and regulations that were framed within India were applicable to all the companies as such, and there were very few examples of companies from outside of India coming to India. So the rules and regulations that were framed were common to all the companies, and the companies operated in a single kind of a economic environment. Now, after this process of liberalization has started, all the companies have thrown their marketplace open to the global players, and this is a scenario in everywhere in the globe, that all the many business houses, they have operations in multiple countries. Now, when you are operating in more than one country, there could be typical problems in the operation of the business. However, our focus today in this class is on the typical problems and issues in working capital management of a firm, and what should be done to manage those typical issues. So before we actually go into the various issues faced by the MNCs, we can talk about the scenario that has given rise to these global players. Now you see the new international economic order. It was set up for this and the signing of the general agreement of tariffs and trade, GATT, by the majority, most of the countries in the world. They have signed this GATT agreement as well as this NIEO, and the purpose of these two agreements was that the business should be global, and the companies should be operating in multiple domains and multiple countries. Now you see what happened because of that is you see, there is a huge amount of change that happened in the international scenario. Now, the major changes, you can see that in the beginning, companies from UK, US, Germany, and all those USA companies, they started operating in multiple countries. For example, if you talk about the names of the companies, you can talk about the Unilever, the basically HLL, Hindustan Lever Limited. You can talk about Coca-Cola. You can talk about Johnson and Johnson, L&T, etc. They started having operations in multiple countries. In fact, even the companies start from China, South Korea, Singapore. They also expanded their operations into multiple countries, and we have seen that China dominated the manufacturing scenario through strategic employments of its cheap labor and all that, and China dominated for quite a few time after these two agreements were signed, and in fact China still continues to be a dominant force in the business when we talk about the multi-country operations of business houses. Now you see the when we talk about this China, the China is probably having about a share of about 16% of the global GDP. So going by that, it is considered one of the foremost players in the business houses. Now, if you look at the companies that were incorporated in India, in fact, in many of the Indian companies are also they're evolving to become global players. There are very good companies in India which are a dominant force in India, as well as they have also. I mean, operation in several countries. If you look at the company from India, which is called, let us say, Maruti Suzuki, it has operations in many countries. Its products are sold in many countries. You can talk about the Tata has acquired company in as far as in South America as well as in UK, and the companies have expanded their operations to other countries, as well as they have acquired other companies and doing operations through them. Now, it was really common during these 1970s and 80s that the MNCs would come to India and acquire several Indian companies and expand their India operations. India has fast caught up with this particular trend, and Indian companies have also started acquiring companies elsewhere in the world to expand their operations into multi-country operations. We can talk about the example of Tata, where it acquired the steel giant Chorus in South America. You can talk about the automobile takeover of Tata in UK, and all those are bright examples of how companies are expanding and doing businesses in the global scale. Now, when we talk about this kind of, deals, now the point is when you're operating in more than one country, every country has its own rules and regulations. Now, so when we're talking about the issues that will specifically be faced by the working capital manager or the operating environment of the business, we can talk about several things. To start with, we'll have the policies and the practices that govern the trade and industry of one country is going to be different from another country. For example, in India, it is very common for organizations to work for 8 hours a day and for 6 days a week. So basically, in India, the working hours is 42 to 48 hours, and many times we also spend time more than what is required in the office. Whereas if you go to USA, the standard working hour is probably within 40 hours, and beyond working hour, if you are spending time, I mean, you are working for the office, you can talk about the over time and all these kind of things. Now, the point is, but the in India there is something called a norm. In USA, that is the norm. So the policies, the practices, the various kind of rules, regulations that govern one business in a country is going to be different from the. So this definitely is going to have some kind of an impact on the working capital issue. The second is the currency risk. Now, when we talk about currency risk, for example, now you talk about a company which is in India, and this company is doing business with a company which is, let us say, situated in Australia. Now, the issue is the import export business that is happening between these two countries are the currency of exchange is Indian national rupee or the Australian dollar. Now, the point is the Australian dollar and Indian currency, they have a particular exchange rate. Now, when we talk about now, suppose the exporter in India, he has exported goods worth, let us say, 1 million to the Australian company, and the Australian company is due to give the send the money after 3 months time, because 90 days is a standard in the international trade. So after 90 days time, that is 3 months time. So the let us say at the time of trade, the US, I mean the Australian dollar to Indian, hypothetically speaking, suppose the exchange rate was, let us say, 50 rupees is was equal to one Australian dollar. Now, if that was the scenario at the time of trading, so the company in India, it was expecting after 3 months that it will receive 50 rupee into 1 million, that is, let us say 50 million Indian currency, that the company was expecting that it will receive that amount of money. But let us say in 3 months time the exchange rate varies, and now the exchange rate after 3 months time, on the day when the company is remitting the funds, the exchange rate has, let us say, become 45 in INR is equal to 1 Australian dollar. Now, what will happen? Now, the company, it will send, instead of I mean the Indian company, when it exchanges that 1 million Australian dollar into Indian currency, the fund available to the company in India will be 45 million. Now you see, from 50 million 3 months back to 45 million. Now, so there is a notional loss here, and that's a huge kind of a risk for the company, because all companies need to plan their cash flow, all companies need to plan their profit. So now, because of doing business in multiple countries, all the companies that are exposed to something peculiar that is called as the currency risk. This currency risk arises when the exchange rate of two currencies fluctuate, and you cannot really predict what is going to be the exchange rate in 3 months time, and so you are basically exposed to this kind of a risk. Now, this kind of a risk means that it will have a definite impact on your cash position. So naturally, and the resources will be impacted. So naturally, it will have a big impact on the working capital management. You can also talk about the various restrictions on the flow of funds between the countries. I mean, the host country as well as the country where you have another country where you have operations. It will limit the investment in your fixed and working capital. Now, if you take the case of India, for example, the remittances by foreign companies from I mean India are subject to various provisions of Foreign Exchange Management Act. Okay. Now, the if you every foreign company is required to comply with the guidelines laid down by this Foreign Exchange Management Act. Now, so this will all have a restriction on the availability of fund and the funds flow that is happening between two different countries. You can talk about the various tax policies and procedures. Now, every country will have different tax regimen, and something that is taxable in one country might not be taxable in another country. So this will have a big impact on the profit available to you. So that is one another important issue of concern when we're talking about multi-country operations. You can have like trade restrictions such as tariffs, such as quota, such as pricing, which has great implication in case of international trade, because the, though we are advocating the free trade in the global level, but there are still many regional trade agreements in place to safeguard the interest of the host country. Now, there are a lot of bilateral trade treaties that are, that have a bearing on the free trade agreement, because host countries always try to give more importance to their own country. So there may be various, bilateral treaties, various regional trade agreements, such as like that. So this will have an impact on the international free trade. So all these restrictions will have some kind of impact on the MNC operations. Then we talk about the very important issue of transfer pricing. Now, usually you see in the MNCs will have operations in various business locations, and you can have manufacturing locations, you can have service locations. Now, what will happen is the value of goods and the services, it will change from one country to the other country. Now, the MNC will have to decide the base price which will be common to all the countries, and then you can add a bit of tax of the specific country, and then you can go for the final pricing. Now, this is an issue where, for example, if you're talking about two different currencies, determining the base value or the base price is also going to be important. Like, for example, when you're determining the base value, are you just talking about the conversion of the currency from one to the other one, or are you looking at the typical factors that impact the supply of Indian currency as well as the supply of the foreign currency? So, because the underlying factors that affect two different currencies might be different depending on the country's economy and the various other environmental issues. Now, the point is, when we're talking about fixing up the base price in two different countries, there could be several considerations that come into picture. So obviously, then we talk about, I mean, so all these things will have a big impact on the operation of the working capital of the MNC. So these are the operational issues that a finance manager will face when he's dealing with the working capital management. Now, having understood the various operational issues, we'll now talk about the various components of working capital and how the MNCs manage these components of working capital according to the various operational issues that they face in different countries. Now, specifically, we'll focus more on the cash flow aspect, the basically the cash management aspect. We'll also look at the inventory management as well as the receivable management, because see, the two most important factors or the components of working capital which are I mean pertinent to the MNC operation is number one is the cash management, and number two is the receivable management. Of course, we'll discuss a little bit about the inventory as well, but these are the two factors that are more important. And why this cash management is more important? Because as we discussed a few minutes back, the the exchange rate plays a big role in the cash management part of the MNCs. Now, if you talk about the cash management, there have been a lot of advancements in terms of managing the cash, and there have been tremendous changes in the cash management of companies. I mean, both inside the country as well as the country. Now, see, if you talk about a very good example in India, prior to 2016 and this episode of demonetization, we have all seen that the use of digital currency in India was very, very limited. Okay, and we all were dependent. In fact, according to the various estimates of RBI, it was said that India is probably the country where the use of cash was the largest. In fact, 97% of all the trades that were happening in India were happening on cash only. And this after this episode of demonetization, if you have seen, there is a big jump in the digital in the trading through the digital currency, and you hardly see people these days carrying any cash in their wallets. So that's a big change in the scenario of in India. So obviously the cash flow of the company will also be changed to the introduction of this kind of technologies. Now the cash flow they have become they have become instantaneous. That means earlier I used to draw a check on the level of cash available, then take the check to the bank, deposit it in the bank. The bank will take 2 to 3 days to clear the check. So obviously in the duration of writing a check and receiving the fund could be as high as 5 days. Now this has given way, this development in technology has given way to a scenario where cash flows have become really instantaneous with the introduction of this EFTs, that is the electronic fund transfer system. So you have NEFTs, and all those things where your money is instantly. Right now you go through internet banking or through NEFT, you make a transfer to an account, and within in real time you will get the account updated and you will get immediately the cash available in your account. So that is the impact of your technology on these cash of I mean the way the companies are now dealing with the cash. You see, domestic companies and MNCs, they also maintain their multi-currency account. When I'm saying that a country has operations in five different a corporation has a operation in five different countries, then you are going to receive your revenue in five different currencies. So it doesn't make sense to have one bank for all collecting all these currencies. So you can have multi-currency accounts, you can have multi-bank transfers, and you can have multi-bank reporting as well. So not just the foreign MNCs are doing it, the Indian banks are also resorting to these things. Now, we all know this term called the Society for Worldwide Interbank Financial Telecommunications. Probably you would not recognize this statement, but if I tell you SWIFT, all of you will be quick to know what is a SWIFT transaction. Now, these banks are increasingly becoming members of the SWIFT network, and so that they can ensure that the accurate amount and is quickly transmitted, I mean, quickly remitted from one party to the other party, and that it does through a absolutely secure channel, so that while the transaction is happening in SWIFT, there are no chances of fraud. So the banks are dependent on now on this kind of a system. In fact, you will be surprised to know that there are about 11,000 member institutions who have already joined this network, and the number is gradually increasing every day, and they are conducting about 33.6 million transactions per day. So you can imagine the volume of transaction in terms of the value, in terms of the value of the transaction. Okay. Now the counterpart of your EFT that I was talking about just now is the National Electronic Fund Transfer, that is the NEFT system, which was introduced by the RBI. Now, the real-time gross settlement, the RTS also, real-time gross settlement for quick and effective transfer of money has also been implemented from one account to the other account. So earlier, when we are talking about the cash management, we were talking about speeding up the collections and delaying the payments. Now that is no more applicable to these today's MNCs which are having multi-country operations, because the transfer of cash, money transfer, fund transfer has really become instantaneous. Now, given these scenarios, you can have various issues in the international cash management. Now, you see, there could be the differences in the banking practices from the one bank to the other bank. Now, you see, the governing body of banks in India is RBI. The governing body of the banks in other countries is like the central bank or the federal bank and all those sorts of things. Now you see this for us the central bank is the RBI. Now the RBI or the central bank, if for that matter in any country, it comes up with a specific set of rules and regulations of dealing with the overseas transactions. Now what is going to be the transaction fee? What is going to be the range of services that you are going to provide, whether you are going to charge your whether you are going to charge your current accounts, whether you are going to give any interest on the deposits, liquid deposits of investors or not. So all those things are decided by these central banks. Now if you see the banking system in India, you still get a little bit of percentage for depositing your money in the savings bank account. But in other countries, many countries don't give you any interest for depositing the money in the savings bank account. Rather, they charge you to deposit the money in the liquid accounts. So in effect, it increases the cost of capital of the clients. Now you can have various differing economic and monetary environments. Now the various monetary and the economic environment where the availability of cash, availability of money will have a big impact on the inflation and directly or indirectly affecting all the operations. It will be there. There will be impact on the impact of the changing technology. So you see now, if you look at these electronic fund transfers, the internet banking, the various payment gateways, the UPIs and all that. So we have been seeing the impact of these changes in the last 5 to 7 years, and we have seen how the position of dealing with cash has changed with the adoption of technology. Now you can also pay, it will be surprised, everyone will be surprised to know that we can also pay 2 rupee for a photocopier that I have taken and through my UPI. Now this is the impact of how technology can change the way we deal with cash. So, and the adoption of technology in different countries could be different. It could have been done with different rates of success. In India, we have done it very, very successfully, but not all the countries have that level of success. Similarly, there could be, if you talk about these technologies, are they all dependent on the internet? So the rate internet penetration of all this country in terms of the population is not same. So these depending on the what kind of internet penetration you have, what kind of technology you are going to use in dealing with cash, these all are the issues of that the MNCs are going to face when they talk about the working capital management. You can also have the legal barriers that could be imposed on the movement of the cash or the transactions that happen through banks and other financial institutions. So you could have, for example, in India, to deal with the non-residents, the rules and regulations of the banking system could be different. Whereas if you talk about the US, the non-residents, the rules and regulations are different. So there could be various legal barriers and various transactions through the banks which are under different kinds of regulations. You can talk about the cultural issues. I'll best example the cultural issue with this thing that if you talk about the Diwali time, or if you talk about a specific day of the week when the traders, they don't deal with the cash, especially they don't make payments in cash. um, for example, in the part of this side, let us say Odisha, usually in terms of on Thursdays they will not give money to the another party. They will rather defer the money payment of money to Friday, or make it an earlier day payment like Wednesday, but they will not pay the money on Thursday. So these are the various cultural issues. And similarly, when you are operating in different countries, these kind of cultural issues will come into picture. In some of the cultures, the money is considered as good. In some countries, money is considered as evil, depending on the various cultures that they follow. So the way you are looking at money, the way you are storing money, the way you are managing money are going to be different, because the cultures treat the money differently. Again, you can have different a very peculiar example is the I mean a case is the different time zones. For example, in USA you have 6 different time zones, but in India we have a single time zone, though the time in the eastern part of the country and the western part of the country, there is a gap of about 1 hour. But still we have made that we will have one single time zone. But in US, you can have 6 different time zones, and each of these time zones are overlapping with one another. Now, if a country talks about one activity in one country in one particular time zone, there could be a lag, there could be an advancement in that in another time zone. So the time zones will also have an impact on the cash management of your corporation. Then we talk about the managing of the cash flow. So whenever we're talking about the management of cash flow, we'll first look at why the corporations need to manage the cash flow. Because you see, we have been discussing, while we discussed the essentials of the basics of the working capital management, we discussed, I remember, that the purpose why we are holding cash is there could be three motives assigned for this purpose of holding cash. You can talk about a transaction motive, that is the actual business transaction of, let us say, paying the salary, paying the bills, paying the rent, and all these things. So that these are all the actual business transactions that you do using the cash, is called the transaction motive. Then there was something called a precautionary motive. You also have some amount of cash in your hand because you don't know what demand will come to you, which bill will be raised against you, or what kind of a demand on the cash will be there. So you hold some extra amount of cash as the precautionary motive. Now, apart from that, also you have some speculative motive, wherein you try to use the cash to generate some rate of return through the course of speculation. For example, if you have huge amount of cash reserve, more amount of cash available with you, you can invest that same cash in some security and you can get some rate of return out of it. So depending on the scenario when you are doing it, you can term it as a speculative gain or a non-speculative gain. So however, companies also have cash for this speculative motive. Now the point is, when we're talking about these holding the cash for different purposes, the three different purposes. Now, to realize this objective of having a certain amount of cash in hand, and to not to overstock the cash, or not to have lesser amount of cash, there are three things that we need to do. Number one is you manage the inflow, then you can manage the outflow, and obviously, if you have some idle cash, excess cash or idle cash which is not currently needed, maybe needed in 5 days time or 10 days time, so what are you going to do with that particular cash? So that is the management of idle cash. So these are the three issues that any company will look at. So if we look at first the management of the inflow, then we'll go to the outflow, and then to the excess cash part. Now you see, the MNCs, they may permit to hold the cash in the see, when we're talking about the inflows, so basically you have to speed up the inflows, right? You have to undertake a strategy where the collections are sped up, and you can have the cash immediately in your hand. So suppose you are operating in 5 different countries, and you ask a buyer from one country to remit the cash to other countries, then obviously that is not going to speed up your process, rather that is going to delay your process. So what can MNCs do? The MNCs, they can permit the various units in various countries to hold the cash in the currency of the country where they are operating, and on their own also they can invest in the host countries various assets, if they have some kind of idle asset. Okay, if you centralize everything, like cash should come to one center and all investments should be done from one center, then probably that is going to be very time taking. See, so some amount of investment could be done on the part of the I mean one branch in the host country. Now, however, the investment decisions could be centralized, and you can instruct every subsidiary unit to transfer the surplus to your country. So, if you see, in the two extreme cases I'm giving you, in one case, the unit of the MNC in a different country, they're empowered to collect the revenue in their own currency and invest on their own in the host country. On the other end, you ask all the buyers to remit your fund to one particular central account, and then you take decisions from investment decisions at one particular place, and then you spread out your money to different countries. I think the second issue, I mean, second method is going to cost you more, is going to be more time consuming. Now you see, if you are holding the suppose I am operating now in, let us say, China, and I have instructed my China unit to collect the revenue in yuan and deposit the money in the account that is in China in the yuan account, and do all the transactions in yuan only. And if they have any surplus yuan available with them, they can now invest that in China itself. Now if you do that, the cost of the transaction cost of converting yuan into Indian currency will not be there. Every transaction cost means there is some kind of a loss that is not there, and the process is also smooth and simple, and it's quite efficient also. Now, how will you take care of, when you are talking about the management of inflows? You have to talk about this exchange rate fluctuation. Okay, now we'll just see how this exchange rate fluctuation that happens. Now, there could be the host countries' various guidelines that block the movement of cash from one country to the other country. Now, you see, for example, let us say in India, you cannot transfer the cash from one state to the other state. But if you are talking about in India, a country transferring the fund to Indian subsidiary will have to pass through the rules and regulations of the Indian subsidiary. Why the money is being invested in India, what is the channel, what is the outcome of that particular investment, all these due diligence will be done by the Indian regulators, and then the investment may be allowed to come in or not. Okay, so the guidelines, there could be several guidelines that will block this kind of a movement of cash from one country to the other country. Now we talk about then the management of outflows. I said I'll be talking about this I mean the exchange rate. We'll do that very shortly now. Now the when we talk about the outflows, the usual technique that has been suggested by many, I mean, the experts is to centralize all the payments. Like I was talking about, like in case of inflows, you basically talk about speeding up the collections, and while we talk about the outflows, the tendency is to delay the payment. Now, earlier, when the concept of the electronic fund transfers were not there, then the method of doing these tricks were called the playing the float. The suppose you are supposed to make a payment on 10th of June, last date of making a payment is on 10th of June, so you'll actually write the check on 10th of June and keep it with you for one day, then remit the fund to the to a supplier, and the supplier will then keep the check with them for 1 or 2 days for the bookkeeping entries and all that. Then they will take the check and deposit in the bank. So the another 2 to 3 days will be there in clearance of the check. So though your date of payment was 10th of June, you ensured that the fund is actually getting deducted from your account 5 or 6 days after you issue the check. So for those 5 or 6 days, you are availing the benefit of the amount for the check for which you have written that amount. You are availing the benefit of that particular amount. So this kind of a technique of delaying the outflow were known as the playing the float. Now, this was possible when we dealt with cash, but when you are and you're talking about the negotiable bills such as checks and bills of exchange, when we're talking about that, then this kind of a technique was very helpful and quite effective also. But these days, when the payments we're doing the payments through NEFTs, through the real time, I mean the RTGS, do you think this kind of a technique will be of any importance when we talk about the NEFT and RTGS? Now, so the we all know that the concept of this float, it doesn't exist anymore, and the delaying of the payment will not be possible through your strategy of centralizing everything. So all the funds will come to me, so I'll centralize everything. That will no more be possible if you when we're talking about the NEFT. Now, so then what to do? Then you can talk about the centralized system of the cash management. It has many advantages of holding the cash balance at a minimum level. Now, it also enables your company to make complete utilization of the cash that is available with you, and you avoid that there is some idle cash lying in your account. So okay, so and how do you do that? To do that, the centralization of this cash management, you can talk about the two methods, that is the multilateral netting and something called a physical and notional cash pooling. Now, what is this multilateral netting? Now, this is nothing but a payment mechanism where two or more parties, they come together and they sum up the transactions that have happened in a specified period. Now, you can apply this to single units or the branches of organization, or you can also do this involving the outside parties. Now, the what you try to achieve through this netting activity is that you are centralizing one place where the funds will come, and you are avoiding the need for preparation of multiple invoices for setting the payments. Now, the it is taken as a tool to pull up the funds for making payments from that particular pool. So basically, you try to centralize all the forms of collections, and the cash inflows, they're centralized in at one point of time. And one method of doing it is the multilateral netting. You can then talk about the customers of the branch managers or the unit heads, or they forward all their payment to one netting center, and the several transactions are bundled together rather than that being treated individually. Now, for example, if you have similar kind of transactions within the last 3 to 5 days, suppose you have purchased material from one particular party, and in the last 5 days you have placed 8 to 10 orders, then all of those can be clubbed together to come up with a net transaction figure. Okay, so we don't treat each of these transactions, 5 or 8 transactions, as independent transactions, because they're dealing with a same kind of the supplier. So what you can do is you can net those figures, and then you can treat that as one. You when well, now that I've understood this concept of this multilateral netting, the what could be the benefits of this thing? You see, if you do that, you save the save on time. You can also save on the various banking charges, because individual transactions and invoices you are not sending to the bank, and bank doesn't have to maintain record of all the individual transactions. Rather, you net all the transactions, make it a big one, and send it to the bank. So the bank will charge you lesser fees, and also it will save you time. Now, effective handling of cash balance will be possible through this multilateral netting, because you are, talking about the small transactions, and talking about a big transaction at the same time. There will be reduction in intercompany cash flow also. Now, you can have better reconciliation with the subsidiaries and the parent company. You can take better decisions about the intercorporate flow of funds, obviously subject to the country in which we are operating. It can help with introduction of better accounting practices. You will have good bargaining power with the banks and financial institutions. Okay, now the since the time this mechanism has been operated and is based on this membership model where uh, the various parties they become the members of one multilateral meeting, the risk of default will also be less. Now, when we talk about the physical and notional cash pooling, now it is because as I told you in the beginning when we're talking about the management of the cash outflows, we're trying to delay the process as much as possible within the possible range, legal range, and without hampering our credit worthiness. So that we are talking about a strategy where we'll centralize all the cash. Now, when you centralize your cash management, you basically resort to nothing but pooling of all the resources. Here, in our case, is the cash is the resource. So you can pool the physical cash resources like notes. You can also pool together just the movement of cash. That means all the cash should be there in the bank account, and then I can make the investment decisions from that particular account. Now you see, in case of physical pooling, you will have to make an attempt to transfer the cash balances of all accounts from all the accounts to the common pool, and all the amounts should be transferred. Okay. Um, uh, any withdrawal or any deposit that you are doing, you will have to do to that particular pool account only. Okay. Now these pool accounts they have to be maintained on a currency to currency basis. So basically, if you're talking about pound sterling, then it is pound sterling where we are not concerned about the exchange or the conversion at this point of time. You just bring in and deposit, or you pull together. Now, for accounting purposes, the interest on cash balance is also paid to the transferring unit branch, and the reconciliation and further investment activity will be taken care of by the various entities. Okay, suppose the banks give you quarterly tax, I mean quarterly interest. So at the time of calculation, if there is an interbank transfer, now the payment of interest on that particular amount is the host bank's responsibility. The bank which is the pooling center, it is responsible for calculation of this interest, and then okay, and this account transfer will have to be done. Now you can have multiple currencies in this kind of accounts. So the see, when there is no actual movement of cash. That means cash is not coming from one drawer to the other drawer. There is no actual lending taking place, or there is no actual movement of cash. We call that to be a notional cash pooling. Now the holding unit or entity which is maintaining this particular pool, it provides the interest statement that reflects the net offset position, obviously the notional offset position, because the actual transaction of cash doesn't take place here. It has to be achieved in that you could have done in the physical pooling. The same thing is replicated by the notional pooling as well. Now we talk about the investment of excess or idle cash. Now you see, when we talk about the investment of surplus in a country where it is generated in the same country, to transfer the surplus following the rules of the host country, and then offer centralized decision choices. So this choice we discussed in the first place, that the companies have two options. Number one, collect the revenue in the host country's currency and keep it for cash management purposes, and issue to the sectors needed. And whenever I mean, let us say investment is required, you can do it in that particular country itself in the same currency. But if you are talking about the centralized investment choices, then you can transfer all the amount to one account, one central account, and all the investment choices will be done from that particular account. Now, in where can the investment choices be? When I'm talking about investment choices, please keep it in mind that we're not talking about investment in machines and equipment. Here, since we're talking about the working capital management, we'll be talking about the investments in various short-term assets and or parking the funds for a very short-term time. Now, if you have operation in one country, you can talk about the traditional investments like you have bank deposits, you have treasury bills, you have commercial papers, all of that you can do. But when you're talking about a multi-country operation or MNC, you can also think about the global depository receipts, which are called the GDRs. We can also talk about the American depository receipts, which are the ADRs. Now you see, these depository receipts, they have become very popular in the recent past, and they're not only used for financing, they're also used for investment in whatever means is needed. Okay. Obviously it should have recourse to yield, risk, financial strength, various purpose, and the duration, flexibility, and credit worthiness. Now, having understood this investment of idle cash, we'll talk about a small model of how the idle cash is invested. Now, you see, when we're talking about the MNC, we'll talk about multi-country, more than one country. So, the effective, now suppose I am sitting here in India and I'm talking about the my business partner or the unit that is operating in, let us say, Sri Lanka, okay, or a nearby country. Now, see, the currencies are going to be different. The rate of return that I get on the investment on Indian rupee is going to be different because our banks will govern that norm. But the, let us say, if I'm talking about a partner in USA, where the currency is dollar, then the investment in US in US dollars, the rate of return is going to be governed by their federal bank. So, based on these understanding, we have developed a small model where this the effective yield on the foreign deposit that has been calculated, that is calculated as 1 plus IF into 1 plus EF minus 1. Now, interestingly, there are terms here which you might not be familiar with. One is the percentage of interest, IF is the percentage of interest quoted on the foreign currency. Suppose if I am here in India, the percentage of interest that is quoted in on the US dollar in US is the IF, and EF is the percentage change. It could be appreciation, it could be depreciation in the value of currency from the date of deposit to the date of withdrawal. Okay, so the if this model will try to see how it works with it example, real life example. Now you see, suppose the MNC X, there is an MNC called X, and it is of the US. It has surplus cash of, let us say, $2 million, and it is planning to invest that in a 1 year domestic bank deposit, and the domestic bank deposit is going to give you 6%, meaning that if the party, the MNC, that is in US, if it invests in US, it will get 6% return on that. Now the company finds that the same 1 year deposit in Australia, it would give them a 9% rate of return. Okay. And at that point of time, when we're talking about this particular problem, the exchange rate of Australian dollar at this particular point, Australian dollar is dollar 0.68. So, meaning that one Australian dollar is equal to 0.68 US dollar. Now, the whole issue is, now you have a motivation. You see, you are getting 6% in US and you are getting 9% in Australia. So, you would have a tendency to transfer your funds from US to Australia and then make the investment in Australia, because Australia gives you 9% return, which is 3% above the US return. However, here you have to keep in mind that while I'm transferring my money from US to Australia, I'll have to pass through the one exchange rate. Okay, so my money will undergo exchange from US dollar to Australian dollar, and then it will be invested in Australia, and then it will get the 9% rate of return. The same money will be remitted to the US company. Uh, to the US in the US dollar, and so another exchange rate will operate there. So in each of these, when the currency passes through these two exchange rates, there will be there's bound to be some amount of loss. So this 6% and 9% comparison, how does it look like? If we see that, you see, I've explained it here. Due to the higher interest rate, the company has decided to invest in Australia 9%. Now the US dollar will get converted. That was 2 million US dollar. That will get converted to Australian dollar at the current exchange rate of 0.68. So the value of Australian dollar will now become 2 million 94 lakh, whatever is the amount. The about 29 lakh, sorry, not 29 lakh, it will get converted into that amount. This is the amount. Okay, this is the amount, if you can see the cursor. Now this will then be deposited. This amount will be deposited in the Australian bank, and the Australian bank will give you 9% interest on this particular amount. So the amount 29 lakh, it will grow to 32 lakh some odd after 1 year. Okay, so that is the amount you deposited plus the 9% interest on that particular deposit. Now you take this money and convert it into US dollar. Okay, and at the time of conversion into US dollar, the exchange rate would no more be one Australian dollar is equal to 0.68 US dollar. So the conversion rate would then be different. Now the difference between these two conversion rates is what defines the EF in this equation. Okay, so and in my example, that appreciation or the change, percentage change in the exchange rate works out to 5.88%. So in the decimal figures, it is 0.0588. So if we calculate the net impact, the net impact, that is the basically the impact is the effective yield on your foreign deposit. So if you convert US dollar into Australian dollar and invest in Australia and then reconvert it into US dollar, your effective yield is going to be 15.41%, which is considered a very good rate of return. So it is advisable to, now please keep it in mind that it is dependent on two exchange rates, one of US dollar to Australian dollar, and the second is Australian dollar to US dollar. And these two exchange rates, if the values are different, the exchange rates are changing, then this value will also be different. You can talk about the receivable management. You see so that was all about your cash management, of how the exchange rates have a very important role in the cash management. Then we talk about this receivable management. Now you can have different kinds of credit system operating in different countries. Now suppose in your country or in the international standard, if there is a norm that will be a 90-day credit period, so you don't have really any choice but to obey that 90-day credit period. Or if you are operating in a country where the credit period is availed by a very few business houses and most of the transactions are done on cash basis, then you have to obey that also, because there is a competitive pressure that governs that particular business scenario. Now for MNCs, these practices will mean that they will be quite diverse. So if you have operations in 10 different countries, the 10 different countries will have 10 different credit policies or credit practices basically. So you are going to operate in different diverse credit scenarios, and so you may have to formulate your strategies, your policies for each of the countries, and change them or tweak them whenever they're needed. Suppose an Indian company, when it is operating in, let us say, Mexico, can have a different kind of a scenario as compared to if it is operating in Canada. So you cannot have one strategy or the policy which will be applicable to all the countries. So depending on the norm that the country has, you will have to change your credit practices in each of the country. Now, when you're talking about these kind of credit policies, now they'll be affected by several factors. Now, what could be the fact, some of the important factors if I list out? Obviously the currency fluctuation, the variation in the exchange rate, the restriction that the banks have imposed on the flow of funds. If you are crossing one boundary, one country's boundary, the inflation rates in both the countries, and so many other cultural issues, and all those things, non-economic value factors also, they will have impact on the kind of credit term or the policy that you will implement for the host, one country to the other country. Now, again, there could be the issue of receivables building up, because because the transit period from one country to the other country. Okay, suppose you are delivering goods from one country to the other country, so there will be obvious organic delay, and the receivable will arise, and you will have no control over that. So that is the typical case that the MNCs they face. Then you talk about the inventory management. Now, as we said, the most important one was cash and receivable. Now, the companies which are operating in multiple, the corporate operating in multiple countries, they need to buy raw material from the local resources. Local sources, and the MNCs always try to do that in the local level. So the inventory build up in the local places will have to be managed locally. The safety stock concept, the cost of stock out in one country vis-a-vis the other country, the kind of the allowances that you provide to your daily workers, if there is a stock out and all that thing, they will have a big impact on the kind of inventory management technique that you will have. And the recent trends of this inventory control technique is to basically the supply chain, the building of the supply chain, wherein you will try to have control over the entire life of the inventory, from the raw material, that is from the supplier of raw material to the transporters to the warehousing. So everything will be connected in a link, and all these things will be monitored and controlled through various through the use of various technologies. So I think with this, the typical issues that the MNCs face for management of working capital is over. Thank you.